US retail sales are soft and producer prices there have fallen. The RBA is expected to look through Australia's jobs market surge in April, and New Zealand house prices look to have turned a corner, while partial inflation data there is surprisingly firm. That's coming up in our 5 Things in 5 Minutes on Friday, May the 16th. And then in our deep dive interview, ANZ Commodities strategist Soni Kumari looks into shifting patterns in Chinese gold demand and what that might do for prices.
The backdrop for gold is structurally supportive as trade uncertainties are not fully gone away, and we see investment demand could emerge after this recent healthy correction, and prices can still move towards 3,600 level by end of this year.
But first, in 5 and 5 with ANZ, US markets are mixed this morning after conflicting signals from the US economy, along with plenty of geopolitical noise from the Middle East and Central Europe to buffet expectations. US retail sales were softer than expected, with the key control group measure falling 0.2% in April, when a 0.3% rise had been expected. Core US producer prices also fell 0.4% in April, suggesting a softening of demand, although not necessarily enough to create a recession, says ANZ Head of G3 Economics, Brian Martin.
So the message we're taking from the data is that at the start of Q2, the data is supporting the expectation that consumption growth is going to slow. However, the data are not necessarily flagging that recession risks are central. In fact, we don't think that's the case. We put recession risks at about 30%. And one of the key reasons for that is that the labour market still looks to be solid. Initial claims were unchanged in the week ended the 10th of May at 229,000. They remain close to historic lows. And the indication we can take from the data is that the labour market has remained solid at the start of May. So when we put everything together, our assessment is that the economy is showing signs of slowing down, as we've anticipated, from Q2 onwards, but that recession is in central case because the labour market still remains solid.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.3%. The yield on the US 10-year Treasury was down 7 basis points to 4.45%. West Texas Intermediate futures were down 2.5% to $61.60 a barrel. Gold was up 0.5% to $3,203.60 US an ounce. The US dollar index was down 0.1%, while the Aussie dollar was down 0.5% to 63.99 US cents, and the Kiwi down about the same to 58.69 US cents. Number 2. Australia's jobs market surged in April as employment rose 89,000 when markets had expected 22,500. That was led by female employment. The unemployment rate remained at 4.1%. ANZ economist Aaron Luke says recent months have seen a lot of movement in the employment numbers.
There's been a bit of volatility in the data recently, like the surprising drop in employment we saw earlier in February. So we expect this increase to be more noise than signal, really. But just given the volatility in the employment growth numbers, we tend to think that the hours worked number and the unemployment rate to provide more stable indications of the labour market, both of which were steady in April.
Number 3. Aaron says the Reserve Bank of Australia should look through the employment strength as it considers whether to cut rates on Tuesday next week.
The tight labour market as well as stronger WPI prints that might give them some reason to think about holding. But just given the global trade uncertainty and weak domestic data we saw recently, we can still expect the RBA to cut the cash rate by 25 basis points next week.
Number 4. Partial inflation data in New Zealand was stronger than expected in April, led by food prices and international airfares. ANZ New Zealand chief economist Sharon Zollner says the results increase the risk that ANZ has to increase its Q2 CPI inflation forecast at 0.4% currently.
For the Reserve Bank, I think probably they're much more interested in domestic inflation and the non-tradable inflation that reflects whether the economy is running hot or cold, and also particularly in wages, for example. So early days, but this data would, on the face of it, suggest that the impact of wage increases on the likes of restaurant and ready-to-eat meals was relatively modest. So I don't think it's a particularly hawkish or alarming story in this data for the RBNZ.
Number 5. In New Zealand, the Real Estate Institute's seasonally adjusted house price index rose 0.4% in April, lifting above the 0.1% and 0.2% rises seen in the past 5 months. ANZ economist Matthew Galt says the market is slowly turning a corner.
We've been expecting house prices to increase by 4.5% over 2025, and there's stock of unsold inventory in the market at the moment, and that's going to restrain house prices in the near term. But as OCR cuts provide further support to the housing market over the rest of the year, we expect house prices will increase at a slightly faster rate.
Matthew Galt there. Now, in today's deep dive interview, ANZ Commodities strategist Soni Kumari looks at China's demand for gold and how it's shifting from physical demand to investment demand, and how that might influence a very volatile gold price.
China is the largest consumer of gold and it accounts for 25% of global gold consumption. And in this total consumer demand, jewelry demand had a larger share than retail investment with an average ratio of 70 to 30%. However, this mix is shifting as demand from jewelry and investment decouples, and there have been reasons for this decoupling. So higher prices, subdued income growth, and weak consumer confidence weighed on jewelry demand. At the same time, retail investment has picked up in the last couple of years because of economic growth concern and poor returns in property and equity markets, which encourage investors to go for pure investment in gold rather than a quasi-investment in jewelry.
So will this shift continue?
Well, this decoupling has been continuing this year so far, with jewelry and retail investment accounting for an equal share in the last quarter. The latest quarterly investment demand was the second largest in the history. It was 125 tons. So we expect this trend to continue this year as factors are still in favor of investment demand. Having said that, growth in investment demand can normalize from a higher base which was set in 2024.
So there's a new mandate for insurance companies to invest in gold. How's that going to impact the market?
Right. So it's not only retail investors buying bar and coins, but also institutional demand have picked up quite strongly. There are clear signs of gold moving from west to east, as evident in increasing trading volumes on Chinese exchanges, both in spot trading, which is Shanghai Gold Exchange, and the SHFE, which is Shanghai Future Exchange. Daily trading volumes have seen a staggering increase in recent months, especially in April. And the most significant development was strong inflows in gold-backed ETF holdings, which rose by a record high of 64 tons in April alone. Presently, the total holdings have increased to 202 tons from a pre-pandemic level of 40 to 45. And while now, the total holdings are comparable to developed markets, but they are still 11% of the total holdings in the US. So this suggests that there is still capacity for Chinese investors to increase their ETF gold holdings as there are institutions are allowed to enter the market. The recent mandate of allowing insurance companies to invest 1% of their asset to gold will see nearly $30 billion flowing into the gold market. And if you calculate this at 3,000 level of gold price, this will be equivalent to 290 to 300 tons of gold demand, which will be nearly 1/3 of annual gold consumption in China. So while the impact will not be immediate as investment from insurance companies will come into tranches, this definitely ensures that the long-term gold demand will sustain and extend the runway for a stronger gold demand.
So gold's had its up and downs. Where do you see the next wave?
Yes, I'll just step back. Prices hit a record high of 3,500 when trade tension, especially between the US and China, was at its peak. And the sharp rise in prices due to trade tension made it vulnerable to any material de-escalation in trade tensions. And this is what is reflected in prices following a softening stance of the US on trade tariffs. So while prices can still fall back to 3,000 level, that's what we are seeing technically. The backdrop for gold is structurally supportive as trade uncertainties are not fully gone away, and we see investment demand could emerge after this recent healthy correction, and prices can still move towards 3,600 level by end of this year.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 16th. Catch you next week as we look ahead to the RBA's rate decision on Tuesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.